Welcome in joining me, Gregoire Theron, for our GraySwan's macro outlook for March 2021. Let's start off by looking at the COVID-19 cases. We've seen the big drop in US cases. Unfortunately, looking at the Eurozone, we haven't seen the big drops, but hopefully as we see the vaccine rollout coming through, we would see further decreases. On the right-hand side, we look at the Google mobility from the retail and recreational travel sectors. And the positive news there is that we are seeing an uptick in data, meaning there's more mobility of people, and that should be positive for economic activity. Then we look at the COVID-19 vaccine doses administered for 100 people. Israel is leading the globe, followed by the United Arab Emirates, United Kingdom, and then the United States. Unfortunately, as you can see, South Africa is lagging, and there has been a worry that poorer nations such as South Africa and African nations would struggle to roll out the vaccines. And that's important because the quicker countries can roll out vaccines, the quicker economies can open up, and therefore the quicker economies could recover from the drawdowns during COVID-19. Looking at Israel, it's key to look at the new severe patients per day and effectively how effective these COVID-19 vaccines are. So you can see as the orange line increases the doses per 100 people within Israel, we've seen the big decline in severe patients per day. Unfortunately, over the last week or so, we haven't seen a dramatic drop further. So we'll have to have a look at the data to see how effective the COVID-19 vaccines are. On the right-hand side, positive news coming out of Israel is that the orange line, which is the death rates with Israel, is still declining. From a market perspective, looking from the beginning of January to where we are now in March, the JSE has rallied extremely hard. It's up 15.67% in Rand terms. If you look at that relative to the S&P 500, which is the US stock market in dollar terms, up only 1.94. What we've seen is this rotation into reflationary assets or into cheaper assets. And you can see that by looking at the MSCI World, which has outperformed the S&P 500 index, and also the MSCI World Value Index, which have outperformed the S&P. Furthermore, if you look at the MSCI US REIT, which is the listed property index, so the reflationary asset, which have also performed strongly. Europe has also outperformed the US. So we've started to see this rotation into other regions and into cheaper asset classes. We've been negative on bonds. If you look at the Barclays Global Aggregate Bond Index there, down negative 4% in dollar terms. And our worry has been that inflation increases and bond yields increases, and you could have permanent loss of capital in those asset classes. From the JSE perspective, we've been positive on basic materials or commodities. Just as economies open up, there should be a bigger demand for commodities, and you can see that the resource sector in the JSE is up 26.1% relative to the financial sector, up only 6.25%. So there's been a big dispersion in returns just on the different sectors within the JSE. We've been speaking about inflation, and our worry is that inflation increases. This graph shows you the 10-year yield minus the 2-year US yield. And coming in from February to where we are now in March, we've seen this yield curve steepening even further. And what it means is the bond market is expecting inflation to come through. And it's important to look at this because this would impact various asset classes and very expensive asset classes such as the global or the US equity market specifically. We also look at various other inflation indicators, and if you look at the ISM Manufacturing Prices Index, and the index, it's on the left-hand side, shows you that if it's below 50, typically prices decline, and when it moves above 50, there's an increase in the prices of goods. Currently, the ISM Price Index is at 86, meaning there's a lot of pressure on prices. Prices are increasing quite quickly. On the right-hand side, you look at the inventory and sales of goods in the US, and what you could see that during the lockdowns of 2020, we saw this ratio increase dramatically. And that means that there was a lot of inventory and sales decreased. This level is now at 1.32, and that means that there's a lot of sales coming through, but the inventories are very low. And therefore, this could cause some pressure on inflation again. Also, if you look at the US dollar savings rates, on the left-hand side, it's some of the highest savings we've seen in 20 years. And on the right-hand side, if you look at the US consumer, which would drive inflation going forward, you can see the disposable personal income, meaning the amount of cash that the US consumer has, is at very, very high levels. It's been driven by stimulus by the US governments, the checks they've paid to the US consumers, and this money needs to come back into the economy and back into the market. And again, that could drive inflation higher. I've spoken about inflation, and the concern is that it could impact very expensive asset classes. And this is the S&P 500 forward price to earnings ratio. And if the ratio is high, it just means asset classes are expensive. And currently, the forward ratio is 21.41. The last time we've seen such levels was during the 2000 market crash, where we saw the tech bubble. So again, these assets are expensive at this point in time, and as yields go up, you could see this rotation out of these asset classes. But it's key to look at global markets. So the purple line shows you global equities, the performance of global equities, excluding the US stock markets. And the gray line shows you the US stock market. And you can see the massive dispersion in performance between the US stock market and the globe, excluding the US. So therefore, within equity markets, we believe there are still a lot of opportunities, and investors should look to tilt into cheaper assets. On the right-hand side, we look at valuations, and the starting point of buying an asset is key to what you could expect from the growth in that asset in future. If you buy a house at very expensive levels, then you can't expect a high growth over the years to come. And the graph on the right just shows you the S&P 500 PE ratio. And if you had bought the S&P 500 PE ratio at 11, and on the y-axis, on the left, it shows you historically what has happened with the S&P over the next 5 years on an annualized basis. And you can see that if you had bought the S&P at price to earnings ratios of 11, the expectation is that you could earn more than 15% per year over the next 5 years because you're buying into a cheap asset. Where are we currently trading? Unfortunately, the S&P is trading quite expensively, and historically, the S&P hasn't done very well over the next 5 years. So the key is to tilt or rotate into cheaper assets at this point in time. An example of that is emerging markets. On the left-hand side, you see the relative price to book ratio of emerging markets relative to the US stock market. And the lower that ratio is, the cheaper it means emerging markets are. And you can see how you can run through cycles where emerging markets are cheap and expensive relative to the US stock market. So as an example, if you had bought emerging markets at the beginning of 2001 or end of 2000, then what would have happened is that emerging market over that roughly 8-year period returned 258.67%. That relative to the US stock market that only returned 9.21%. So it points out that if you buy assets at a cheap valuation, the expectation over the future should be higher. A key point here rather is that the JSE All Share Index over this period also performed very strongly. It's up 304%. And the point is that the JSE is emerging markets, and as emerging markets do well, the JSE should also do well. So if we go into this environment where we do go into a commodity bull market, it should typically be good for emerging markets, and the JSE should do well because of its high exposure to resource stocks. From a Rand dollar perspective, our investors always ask us, when's a good time to take money abroad? And this slide just shows you in the blue line the Rand dollar exchange rate over time as it moves relative to the fair value. So what do you think the value of the Rand should be relative to the dollar? And what you can see is that the Rand is currently trading close to fair value. So from that perspective, we do think it's potentially a good time to start taking money abroad. But we do look at other factors. Firstly, we look at the US dollar. The US dollar would drive how currencies performs over time. And what you can see in this slide is that from From 2011, you've had this big bull market in the US dollar where it's strengthened, and most currencies weakened against the US dollar. It was not just the rand, it was most emerging market currencies weakened dramatically, also other European currencies. And if you look at just over the last year or so, we've seen the dollar actually depreciating, and that's why we saw the rand strengthening so much. Our concern, however, is that if you look at the difference between the US 10-year yield and other international developed market 10-year bond yields, currently what we're seeing is that the spread between the US bond yields and other developed market bond yields are increasing again. And in periods where the US yields are substantially higher than other developed market yields, we have seen historically how the dollar actually strengthens. So we've started to see this trend again, and that means that the dollar could start strengthening again and the rand could weaken. The last slide in terms of the currency, what we also look at is the US high yield index versus the US government 10-year treasury yield. So the US high yield index are really non-investment grade bonds. So it's companies which are issuing bonds which are not investment grade. And basically you can look at that spread relative to the South African bond market. So what we've seen historically is when we had the blowout in asset classes in March of last year, we saw the spread widening dramatically. What you can see in black is also how the rand currency weakened dramatically during that point in time. And you can see the correlation between the spread in US high yield and the US 10-year treasury yields and also the currency. Our concern at this point in time is that the spread between the US high yield and the 10-year government bond yields are at the lower levels, which we've seen over the last 5 years. And therefore, we think there is again a risk that the spread could increase again, and that could be negative for the South African rand relative to the dollar. On the last point is we do have our clients asking us, should we invest all our money abroad? And there's a lot of opportunities in the South African market. And this is a slide that just shows you the South African inflation-linked bond yields. And that yield is relative to inflation. So currently, the South African 10-year inflation-linked bond and the 30-year inflation-linked bond are paying inflation plus 4 and 4.5% respectively. Our concern is also that as oil prices increases, this should drive up South African inflation. And if inflation goes back to 4.5%, effectively buying inflation-linked bonds, you could get a yield of 8.5% to 9%. It's a much higher yield than cash yields are currently. South African investors has also been investing into cash yields historically just because interest rates has been so high. But the Reserve Bank has had to cut interest rates to try and stimulate the economy. And therefore, cash yields over the short term, we believe, will underperform inflation. You will get poorer sitting in cash. And therefore, for investors sitting in high cash allocations, we do believe it's an opportune time to invest into other South African assets which are giving much higher yields, such as inflation-linked bonds and such as South African nominal bonds. Thank you for joining me. Hope to see you soon. Bye-bye.